Hello guys and welcome back to that investing channel. So a lot has happened. I'm trying to keep you guys updated as much as I can, but it's been quite a roller coaster in terms of the market with earnings and this AI narrative about killing software stocks. And my portfolio has been going down. So I want to talk about it today. I want to bring you guys a full update. I've been buying massively into two positions and actually have a brand new position to bring to you guys that's quite substantial as well in the portfolio. And I'm quite keen to get hold of this one at what I believe is a very good price. So I'm going to share that with you guys today. And also, towards the end, I'm actually going to bring to you guys, I've got a little spreadsheet that I've got going of all the sort of fair value sort of price targets I've got for my stocks that I hold in my portfolio and sort of what are sort of returns I could see them delivering based off DCFs that I've done. So I'm going to share that with you guys today as well. It's very simple. It's like green, orange and red in terms of valuation. So maybe someone can get something out of that. And if you guys do get something out of it, then please feel free to maybe follow along, leave a like and consider subscribing to the channel to watch how we can grow this portfolio. So here we have the overall portfolio. This is combined between two separate accounts, my Trading 212 account and my international brokerage account. And majority of it is held in Trading 212. We have my stocks and shares ISA, which makes up a big part of it. And we've got my invest account, which I'm currently using because we cannot invest until April 2026. And it is killing me not to add more to my stocks and shares ISA. But here we have the overall value sitting around £78,000 or so, and we have a cash position that's £1,700 or so. Cash position has actually come down quite a bit because it was about double that, and we actually used a significant chunk of it to buy into our new position as well as a few other stocks. And we can see all my buys have been around this sort of period. They weren't really tracking around here. I was still buying, so I can't really say that I'm timing it well or anything. But I've just been adding now that I'm seeing a lot of weakness, especially with the software stocks. And we can see our return is still beating that of Vanguard, which is the benchmark that I compare myself to, which is the S&P 500 index that I would be investing in if I didn't invest in individual stocks. And that's sort of since we got started back in 2023 or so. And altogether, I'm still massively motivated to keep adding to this portfolio. I know that sounds really silly, but I'm seeing a lot of my stocks go down towards positions I would have killed for earlier, and I'm keen to add. So what does the portfolio currently look like? Well, hopefully you don't spot the one that we've been buying, but overall the portfolio looks pretty good, but there is some ones that are massively detracting from it. So Amazon and Brookfield are both amazing positions that sort of chop and change with each other. They're over 20% of the portfolio. They're doing really well. And they're up by about 34% each respectively, which is really weird. And that's about 40%, 41% of the overall portfolio. Tasmea is about 13% of the overall portfolio and is pretty much flat. I'm really liking this position. I'm hopefully adding more and hopefully get to about 15%. But is a small cap in Australia, focused on the sort of recurring revenue and maintenance of critical infrastructure and businesses and electrification over in Australia. And I really like that business. It's a smaller one. I don't know if I want as much allocation to it. I wanted to get over 10k invested, and I have. I'll probably continue to add if we see these current levels. Topicus is down more than 26% in the overall, and we've still continued to add to this one. This is one that's got an amazing dip, well past what I expected. And overall, I'm just continuing to add because I'm seeing great value with this business. Now, some people may disagree, think software is dead. I just don't believe that narrative. I think Topicus is one of the world-class businesses along with Constellation Software, and the acquisitions market is probably going to look pretty good at this time with Topicus because, of course, Topicus is an acquirer of software-based companies. And if that is the case, then I think they're going to be seeing more benefits than negative with AI. They manage critical infrastructure, and no one's really going to be vibe coding in the likes of like critical infrastructure sort of space where it's less than 1% of their overall revenues. I just don't see it happening. Melly is up at 13%, doing fairly well. Meta is a position that have been doing very well. We're going to talk a bit about the earnings later on. And then we've got S&P Global and a few other smaller positions, all of which are less than 5% of the overall portfolio. And overall, I'm just looking forward to seeing how this sort of overall portfolio grows. I'm going to talk a bit more about my buys now that I've sort of covered this. My brand new position is with Microsoft, and this is a company that I've been watching for a while, about last year or so. I sort of sold out of it or didn't buy enough of it. I think I bought 2 shares around the $300 mark and sold it when it got to around this value, which I think is ironic. But in terms of my past sort of conviction on Microsoft, it's an amazing business, amazing dividend growth based company. It's growing in all the right areas really well. AI is driving that. It's closely linked with OpenAI, which I don't massively like, and probably the problem with why it's sold off recently. But we bought about £2,100 worth, around 7 shares, at an overall fill price of $424. And this company is just on a roll, really, but the market doesn't like it because of how it recently reported its earnings. It was down around about 11% on the day. It was pretty impressive of a drop, the biggest I've seen for Microsoft ever, really. And it's just something I couldn't pass up. And I've been meaning to add to this position for a while. There was a good opportunity back in April 2025, but there was loads of things going on sale then. And now we're seeing a good opportunity with Microsoft, in my opinion. And the DCF that I show in a bit will probably cover that. So just before we get onto a DCF for Microsoft, I want to talk about the earnings report because it really wasn't bad. There was quite a few things in there. Revenue up to $81.3 billion, increase of about 17%. Operating income coming up considerably at 21% increases, and earnings per share increasing by 60%. But if we take out the OpenAI involvement, it's only up 24%. So there is a significant sort of change with how OpenAI is affecting these numbers, and I think that's what people are mainly concerned about. And the main thing that has led to this biggest sell-off in Microsoft that we've seen in a long time, 10 to 11%, was this one line, in my opinion. I think this led to a massive sell-off in the stock, which was approximately 45% of Microsoft's remaining performance obligations balance is from OpenAI. The significant remaining balance grew by 28% outside of OpenAI. So RPOs are doing well on just their own, but they grew massively with OpenAI involvement. And the OpenAI dependency, if you like, is becoming stronger in Microsoft. It's no longer a heavily diversified company with a strong, reliant sort of recurring revenue stream, which it is still, but people are thinking it more of an AI play that so far is getting beaten by Gemini. That's what I think people are thinking. People are thinking that Microsoft will collapse because OpenAI is not performing as well against Gemini. And whilst that may be true, and OpenAI's sort of contracts of performance obligations are all very confusing and very circular, which I don't like, and I don't like Microsoft's overdependency on it, I just think this business has a lot more going for it. There are a lot of things with Microsoft that are really exciting about it. OpenAI is one of them, but it's not the only one. And I think to focus on just an OpenAI sort of segment is a bit of a mistake with this amazing business that we're seeing. So now let's look at Microsoft's operating cash flow sort of DCF. I'm using that metric mainly because that's the one I think best shows the fundamentals and intrinsic value of the business. Free cash flow at the moment would be what I would normally use, but the reality is that it doesn't really reflect the company's reinvestment into itself, the reacceleration in sort of cash flows and in revenue. So it's just a bit of a better metric to use whilst this business is now being CapEx intensive, along with big ones like Amazon, Meta, Google. All of these businesses I think are better valued using operating cash flow. In this particular case, we've done 5 years and a 15% growth rate in operating cash flow, which is below their 5-year averages, and we've actually seen a re-acceleration in operating cash flow growth for this business. So I think this is more than achievable and a conservative estimate. We've also got a price to operating cash flow metric, if you like, of 20. At the moment, it's sitting at 19. So this is if nothing changes or as a slight multiple expansion. And if we're looking at a 5-year time horizon of that, sort of past 5 years, it's actually been 25 sitting in that sort of range. So really 20 is actually fair. After all of that, we now get a 16% CAGR over the next 5 years each year and a fair value of about $562 per share. So I think this is an amazing business trading at a very fair valuation on conservative estimates at the moment. So I started a position. Which brings its weighting in the portfolio just sitting around here at 2.7%. It's a starting position. If it continues to trade down, I'll continue to buy into Microsoft. There is other companies I see as very attractive here that I have also been buying into, and Microsoft is just one that I wanted to add to at this level because I really saw a good opportunity to get this world-class business. Now, additional to Microsoft, I've also been buying into Meta, and the earnings report that they more recently had was very good. Here we've got some of my Meta position, not all of it. I've got one other share, I believe, in my Trading 212 Invest account. This is in the Stocks and Shares ISA. But here we can see I've got around about 7.9 shares here, so around about 9 or so shares overall. And our cost basis was sitting around about $650 or so. And the market's doing really well with it. It was up around about 11% on the day, this big sort of jump here. And that's because their earnings were really good. And I sort of want to go into those a little bit. They just smashed it across the board. Their revenue increases quarter over quarter. Year over year was about 24% and 22% respectively. Their cost expenses massively increased as well, something to consider with this business, 40%. And their diluted earnings per share massively increased to $8.88, which was a massive beat on terms of analyst recommendations. I think analyst expectations was sitting around about $8.30. I haven't got it in front of me. But overall, they just really massively continue to beat and perform. This was a trend I was seeing in Meta before I owned them, and now it's one I'm happy to see continue now I'm owning them. And one of the main things why I made this over a 5% position was because I really thought this was going to happen. I really thought Meta was going to overachieve going into this quarter because Q4 in 2024 was actually not that strong. And I thought we was going to see a good year-over-year sort of uptick. And I thought their guidance was going to be good. And it's actually very good. It looks like they were guiding for around about 30% revenue growth going into Q1 of 2026. So really, I overall really think this business is doing well. We bought it when there was a dip in the stock because people were worried because earnings per share missed for the first time in like 10 quarters, mainly because there was a one-time tax hit. And people just sold off the stock. And it doesn't make any sense because this is a world-class business. You've got to be fair to the business that they're not always going to be 100% perfect. And Meta is pretty much close. So I'm really glad to have more involvement with this business. Now, just for fun, now that we've covered the portfolio, the positions we're buying, or mainly just one really I've talked about, but I've also been buying two others that I'll jump into a little bit. There's multiple other positions that I think are offering really good value in my portfolio. The two that I'm currently buying alongside Microsoft is the likes of Topicus and Tasmea. I've still been continuing to add to these positions regularly, £200, £300 here or there as the months have gone on. And I'm really liking the value and quality that they're bringing to the portfolio. Tasmea, I think, is arguably more undervalued, but is also a smaller stock. It's more insulated from AI as well. It's also in a region that is maybe going to see less GDP growth as well. So there is some things with it, but overall it's quite interesting to see. The key metrics that we've got here are the ones that I use to value these businesses. The growth that I'm expecting for the businesses are here over a 5-year time horizon, and I try to be conservative with that or use the company's guidance. The DCF and fair value returns are here. This is per year in the centre. And what we currently see is the vast majority of my stocks are offering good value right now and are currently on my buy list potentially. I've sort of tried to pad out the ones that I think are higher quality, ones that I think are offering maybe a little bit of a better return. I'm trying to build out quality rather than better return. Just because a company is cheap in my DCF, the likes of VTech and the two Japanese stocks offer potentially the best value. And yet I want to see how they perform going into earnings. VTech disappointed last quarter or two or so ago. I think it will disappoint again in this quarter. Not because of any real reason. It's just because they had such a good performance in 2024, which is weird. But yeah, they slightly missed, and I think the company's getting really punished by the market. So I could see myself adding. As well as this, the Japanese stocks, I'm not looking to add to. They were speculative. They're less than 1% or 2% of the overall portfolio each. So really, I'm not looking to add. I just want to see if I'm actually right with what I'm seeing in the market as good opportunities in the Japanese markets. And then if we look at companies that I think are overvalued right now, we have S&P Global. I'm not adding to it. I think it's one of the lowest free cash flow growths in my portfolio, but it's also one of the most dependable. It's got excellent quality moat, and I'm not selling it even though it's trading at 30 times price to free cash flow. Additionally, other companies that are offering really good value at the moment are, I would say Melly is still really attractive. I know that sounds controversial. It's up by around about 10 to 15% this month or so, but it's just doing really well. That's because it was undervalued even more so before. So yeah, I really like these positions. I think there's lots of opportunities to grow in the future. Brookfield Asset Management and Texas Pacific are higher valued businesses, higher quality businesses that offer significant dividends as well for the likes of BAM. And I just, these are my sort of positions that I am sort of trying something a bit different. Not trading around the valuation so much, more trading around the quality of the business, the likelihood that the market will reward its overall fair value, the companies that are always sitting well above their fair value. And TPL is definitely one of them. So overall, I'm really liking where the position's sitting. I think that there's a lot of runway for growth in this portfolio. And hopefully you guys can maybe look at this sort of Excel spreadsheet and maybe use the fair values to compare against your own sort of models for what you think are likely to return in the likes of this business. And I want to see what you guys think of these sort of key metrics and DCF returns. Do you think they're likely to happen? Let me know down below. And as always, thank you for watching. I appreciate it. And I'll catch you in the next one.